And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Welcome to today's edition of The Real Investment Show. This is another one of our continuing interview series, and today our very special guest is Brent Johnson. He is the author of the Dollar Milkshake Theory and, of course, has a long history in the financial markets. Brent brings 25 years of experience in the financial markets to his position as CEO of Santiago Capital. You've seen him on a lot of various media outlets, Adam Taggart, Thoughtful Money, where I've spent some time also. So we're familiar with each other, and of course, we have a lot to get into today, talking a little bit about the dollar. So kind of setting the stage here just a bit. You know, Brent, dollar pessimism has been everywhere. And it's interesting, back in 2022, there was the end of the dollar and then de-dollarization, and then it kind of went away for a while when the dollar rallied. And then when the dollar declined again, it's back. And so we've got this dollar, kind of this dollar pessimism everywhere. And yet the dollar remains the reserve currency. And I thought we could just talk a little bit about kind of your thesis on the dollar and why it remains the reserve currency. And we'll just kind of go from there. So I guess just kind of starting from broad picture, kind of what's your view on the dollar in general and your idea behind the milkshake theory?
Yeah, well, first, thanks for having me on. I've been a fan of you guys for a long time, so it's fun to talk in person. Really, I mean, the thing about the dollar, and people will often ask me, like, why do you talk about the dollar so much? And the reason is because it's very hard to understand what's going on in global markets if you don't understand what's going on with the dollar. And that's because the dollar literally underlies everything. That is the world's money. Whether you like it or not, whether you think it should be or not, it is the money that the world runs on. And so it's hard to be wrong about the dollar and get everything else right. It's not impossible. It's always right. It's always possible to get lucky, but that is why. And as it relates to the dollar debasement versus the dollar losing global reserve currency status, those are two completely different arguments, because all fiat currencies lose value over time. Mm-hmm. They are designed to lose value, and that's why the governments use them. I've talked a lot lately about sovereignty, and you can't be sovereign if you are beholden to something or someone else. And if you can't control the money in your own kingdom, then you're not truly sovereign. So that's why money is so important, and that is why governments prefer fiat versus some hard form of money. Right. So for the people who say the dollar debasement is going to continue and it's going to continue to erode the purchasing power of the dollar, I'm not going to disagree with those people. History proves that is the case. Well, yeah. But that's not the same thing. That's not the same thing as the dollar losing global reserve currency status. And that is a very important thing. Right. If the dollar loses value, but loses value at a slower rate than the rest of the world, that has huge implications for capital markets. And so that's the genesis of the theory and why I think it's so important. No, and I absolutely agree with you. I just had this conversation the other day with a gentleman, and he was like, well, the dollar, it's lost 90% of its purchasing power since 1970. And it's like, yeah, because the economy's grown. If the dollar wasn't losing its value on a relative basis, you would have no economic growth. You'd have no inflation, which is what you need to create economic prosperity. And what that assumes is that you just stuck your dollars into a jar in 1970 and you never invested them in anything. Right. And so you never created any value on that dollar. It's just sitting in a jar somewhere. So, yeah, it's lost purchasing power. And it also assumes you had it under a mattress and not in a bank account where interest was being generated. Right. And when you put the interest in there, it shows a much different result. Now, this is not to say that fiat currencies are great. Right. And it's not to say that you should be able to put your money in fiat currency and it should retain value. Knowing that is half the battle, right? That's correct. And so, but again, I think we get to two different arguments of will the dollar lose purchasing power, or will it be, lose its global reserve currency status? And I don't think that's going to happen anytime soon on the latter. Well, and yeah, well, let's talk about that real quick. But yes, the dollar is going to lose purchasing power because of inflation. Period. Because the economy, if the economy grows now.
If the economy is not growing, we get into a deflationary environment. Well, that's a totally different thing we can talk about. But as long as the economy grows, the dollar, if you're not investing it in stocks, bonds, gold, something, right, it's going to lose relative purchasing power. But let's talk about the reserve currency, because I think this is really, there's been a lot of, look, gold has had a fantastic year in terms of relative performance. It's doing fantastic. And of course, immediately when gold rallies, whenever it rallies, right, you get everybody comes out like, see, everybody's moving away from the dollar. Nobody wants the dollar. And, it's like, well, no, it's going up because the dollar is declining. And so reserve currencies are being invested to do exactly what we just talked about. They're trying to maintain the purchasing power of those dollars by investing in asset prices that are going, or asset classes that are going up in price. And so, this is really important. And, I'd like you to explain a little bit about how reserve currencies work and when governments are maintaining reserves and how that flow of reserves work between countries.
Sure. So, when you talk about a reserve currency, what you're really talking about is what currency, now not what asset, not what speculative investment, but what currency does the majority of the world store their quote unquote savings or their reserves in? And because the dollar is the global reserve currency, and I should probably take a step back and I'll make this quick, but part of the reason the dollar is the reserve currency to begin with is because, coming out of World War II, the US was the global hegemon. We were on a gold standard. Mm-hmm. When we left the gold standard in 1971, there was a brief moment in time where the world had the opportunity to move away from the dollar if they chose to. Shortly after that, the U.S., made this agreement with Saudi Arabia where Saudi Arabia would price oil exclusively in the U.S. dollar. And since the entire world needed oil to run their economies or energy to run their economies, they needed dollars to purchase that oil. And so that is the reason, or that's the primary reason, or at least part of the reason, the origin of why the dollar is the reserve currency. And so that's what they would save in order for their money that was not being put into the economy. Mm-hmm. And that contributes to the dollar demand to this day, because despite all of the talk about, the death of the petrodollar, oil is still priced in dollars. Even if it's invoiced in another currency, it is still priced in US dollars.
Can I stop you there? Can I stop you there real quick? Because I think this is a really important point that investors need to understand is when things are priced in dollars. And it's like, okay, I'm getting out of the dollar, so I'm going to buy oil. You're not out of the dollar. It trades in dollars, right? If you buy gold trades in dollars everywhere in the world. So you're not really getting out of the dollar by buying other assets. And and I think that's a really important point that investors need to understand, is that when you buy another asset priced in dollars, you're not leaving the dollar.
Well, you're not leaving the dollar system. You may be hedging your dollar exposure, but you're not leaving the dollar system.
Correct.
And that is a very important thing. And when the price of a commodity changes in dollars, that has huge effect if you're a non-US dollar based investor or operator and you have to buy needed commodity inputs that are priced in dollars. Because even if you spend your local currency to get it, you're going to be spending the local currency equivalent of whatever dollar amount that exporter of oil is going to be asking for it. So it doesn't matter if it's invoiced in yuan or lira or reals, you're going to be paying a US dollar price for it.
So real quick, just back to your comments a minute ago about, kind of after World War II, we were the reserve currency, and then they had that brief moment when we came off the dollar, they could have changed it. Two things that I think are interesting, and this is really a question just for you. I'd like your opinion on this. I think two things have happened. First of all, if I'm going to store my reserve currency, right, I need to store my reserve currency somewhere where there's a rule of law. In other words, the government's not going to show up and just take all my reserves, at a whim. Right. I need to have some type of liquidity and depth to the market so that there's some stability to me executing foreign transactions. I'm going to buy oil from, Venezuela, and I'm going to ship it over to, Africa and sell it there. And I'm going to do this in dollars. I need to make sure there's enough depth in that currency that the price remains somewhat stable during the transaction time that's occurring. And then, of course, also, there needs to be enough strength within the overall economy to ensure the viability of that currency over time. And when you start looking around the world, there's very, very few places, if any, that offer that relative to the U.S. dollar. I mean, storing things in yuan, you never know when China's going to wake up one morning and say, yeah, we're just going to take it all. The other side, the second part of that question, though, is do you think when the Eurozone, when Europe went out of being individual countries and became the euro, was that a benefit or a degradation to the potential for, another reserve currency to take the U.S. dollar place?
So I think it was the potential for partial reserve, but I don't think it was ever going to be something that could seriously challenge the U.S. dollar. And there's been some people who have said that the Europe launched this as an attack or as a challenge to U.S. hegemony. Well, you have to think back, what was going on at the time of the launch of the euro? Well, at the time of the launch of the euro was the height of the Cold War. The 90s, late 80s was the height of the Cold War. And that was kind of when the whole concept of the euro started. Then in the 90s,
Mr. Gorbachev, tear down this wall.
The wall came down and kind of we had kind of a little bit of a détente. But the idea that Europe was going to fight against the United States at the height of the Cold War, when they had Russia right on their doorstep, who could potentially, start another war, I think it's a stretch. So I think the U.S. was okay with the euro being launched. The U.S. supported the launch of the euro. They could have very easily squashed it if they didn't want it. And the other thing and this is my opinion, and I cannot prove this, but I think the launch of the euro in some ways helped to weaken the U.S. dollar. And the reality is the U.S. does not want the dollar to be too strong. They don't want it to be too weak, but they don't want it to be too strong either, because a really strong dollar crushes the global economy. And that's kind of what you were saying earlier. Right. If the dollar rises, you're going to have deflation and assets are going to fall. What you need is the dollar either kind of trading within a band or generally falling over time for the global economy to keep working. And so the fact that the rise of the euro, that was another place for people to park some of their reserves, which took some of the upward pressure off of the dollar. Remember, in the mid 80s, the reason the dollar came down so much from the mid 80s to call it early 2000s was because it was systematically weakened on purpose via the Plaza Accord. When you look back across the last 40 years, all of the major programs that the Federal Reserve and the government took with regard to the dollar was efforts to weaken the dollar, not to strengthen it. And it's because a strong dollar puts a chokehold on the global economy. Now, that also, though, gives the United States a tool to put pressure on the rest of the world. So if and when they do want to choke a part of the world, all they have to do is make a move to temporarily strengthen the dollar, and the rest of the world gets choked out very quickly.
Yeah. Just real quick here, Brent, I just want to bring up a chart. This is a 50-year chart of the U.S. dollar. And this just goes, I just bring this chart up to kind of prove your point, is that if you go back and look at the dollar historically, and I'm just waiting on Brent here. There we go. This is the U.S. dollar index. And when you take a look at the dollar, it is always the dollar relative to something else, right? So the only way to tell it to say, the dollar is strong or the dollar is weak, in isolation, you can't say that. You have to compare it to something else. So it's the dollar versus the franc. It's the dollar versus the British pound. It's the dollar versus the euro. So it's always compared to something else. So when you look at the U.S. dollar index, it's the U.S. dollar compared to a basket of other currencies. And historically, what you'll notice is that the dollar trades around 100, right? That's kind of the fair value. And the dollar currently is trading exactly where it was back in 1970. So for all these, parameters, all these kind of, fear mongers going, oh, the dollar's losing its value, everybody's getting out of the dollar. Well, it's kind of hard to say, because when you look at the actual chart, the dollar's been rising steadily since 2008, since the financial crisis, and is back at fair value. And again, so when to Brent's point, importantly, If the dollar is trading weak, in other words, it's trading below 100, just as an example in this case, then that is a impact on transactions between countries. So if the dollar's too weak, that impacts trade because, for us, right, we're exporting if the currency is stronger in another country, they're able to buy our goods cheaper using their currency. If the dollar's too strong, it works in the other direction, right? It's inflation on them because their currency is weaker than ours and it's costing them more to buy the goods or services from the U.S. So understanding that, and this is to Brent's point, is understanding that this relative relationship is very, very important, not only just to reserve currencies, but also to global trade, global economics, and there's very big impacts because of that. So sorry to digress, Brent, but I thought that was an important point.
Well, it's extremely, and kind of to my point at the end, how the U.S. can raise rates or it can institute policies to strengthen the dollar. It really puts a chokehold on the rest of the world. And here's the reason why. And this gets a little. I'm going to back up a little bit.
Okay.
Investors need to understand that we have a debt-based monetary system, which means money that is created gets loaned into existence. When you hear this money printer go burr meme, they are not physically printing dollar bills.
Right.
It is new money getting loaned into existence. It's a credit-based system. And so
and I just wrote an entire article called Money Printing by the Fed Fact or Fiction, which is exactly to that point. But thank you for bringing it up.
Well, as U.S. citizens and investors, we don't really have to think in any other currency other than the dollar. But every other country in the world has to think in two currencies. And the reason is that it's something called a carry trade. When you have a carry trade, you borrow in a currency and you have a cost of capital. And then you go put that money into a project that is going to pay a higher return than your cost of capital. And the spread is your profit.
Right.
The U.S. only has to think of a carry trade in U.S. dollar terms. The rest of the world is dealing with a carry trade in two different currencies. They're dealing because they have the same system in their home. So they have a carry trade to deal with in their local currency, and they have a carry trade to deal with in a dollar when they operate on a global stage. The reason that's important is when the currency is strengthening, then that means that a carry trade is going against you. So if you are in Europe and the euro is getting stronger versus the dollar, the euro carry trade in your local economies is going against you. If the euro is weak, you're fine domestically, but when you operate on the global stage, the US dollar carry trade is going against you. And so just on that fact alone, the US-based investors have a huge advantage over the rest of the world because they only have to fight one battle at a time, whereas the rest of the world has to fight two battles at a time. And it's a little bit nuanced, but it's important to understand. Europe doesn't want a crashing euro, but they also don't want a spiking euro because they're exporters. If their euro spikes, that hurts their economies. And earlier this year, when the dollar was falling and the euro was rallying, you started to see some comments that Europe was worried about the strength of the euro putting downward pressure on their growth prospects. So it's a very nuanced thing, but it's important to understand if you're operating either investing internationally or operating on the global stage in some form. So the fact that the rest of the world has this dual carry trade to deal with, both in dollar terms and their local currency terms, this goes back to the comment that then Secretary of the Treasury John Connally made in 1971 when they broke from the gold standard. A lot of countries were upset because it was no longer anchored to gold, to which Connally responded, "The dollar may be our currency, but it's your problem." And that is the truth. That is as true today as it was 50 years ago.
So a couple of things. So, when we start looking at this, right, look, there's a lot of critics out there. You and I have a lot of critics, trust me. And, one of them is like, the dollar milkshake theory predicts there's going to be a huge super spike in the dollar. That hasn't happened yet. So obviously it's wrong. But again, as I showed you in the dollar chart a minute ago, the dollar's been steadily rising since the financial crisis. It's in a very good, positive, bullish trend. Yeah, it goes up and down, and every time it comes down a little bit, it gets over, just technically it gets overbought, it pulls back. It's like, oh my gosh, it's the end of the world. But the dollar is strengthening. The U.S. economy is doing fine. Has anything really changed in your view about, in regards to the dollar milkshake theory in general? Has anything, changed in terms of your views?
Not really. So I think it's important to understand the dollar milkshake theory was really a framework for me, how I would think about the markets going forward. Because at the time, when I first started to talk about the interest rates were still at zero or close to zero. And I thought we were moving into an environment where finally, after 40 years, interest rates were going to start to rise. I thought that would make the dollar rise, and I thought that would cause all kinds of problems that hadn't typically been there because nobody had to deal with a rising interest rate environment for a long time. And so kind of all of that stuff came through as far as how the assets would react, with the exception of the super dollar spike. Now, the dollar, went up pretty quickly in early 2020 with COVID. Then it went back down, and then it rallied very strongly in 2022. And we got very close to the crisis that I was expecting in 2022. But ultimately, the government's got it under control. And what I would say is, listen, I don't know for sure that I'm right. I don't know that the dollar is going to spike. But to me, the risk is that the dollar spikes. The risk is not that the dollar falls. Because if the dollar falls, that probably indicates that the economy is expanding, right? Right. And we own a bunch of assets. Again, if the process by which they create new dollars is new dollars being loaned into existence. If new dollars are being loaned into existence, then credit is probably expanding. If credit is expanding, then businesses are probably expanding as well. That's not something that I typically worry about. What I worry about is these sharp drawdowns due to some kind of a crisis. And in a sharp drawdown due to a crisis, the dollar spikes. It doesn't fall.
Right. Well, and again, this is, kind of, to your point, we were just talking about this the other day. There's a lot of people concerned right now about the AI debt, right? So there's been a lot of articles out lately. It's like, these AI companies, there's all the circular financing. And I'm not arguing that point because that's going on for sure, right? So I'm not discounting that at all. I'm not discounting the fact that they're taking on a tremendous amount of debt. But I think the one thing that is being missed by these arguments is the impact of where that money's going to be spent. And there's a very different outcome that, and I'm still working through this myself mentally, right? So I don't have my full thesis in place yet, but this is what I'm thinking about. When we injected the economy with a whole lot of money, following the pandemic, people went out, they spent money that they didn't have before. And we had the economy shut down. So we had this inflation spike because it was a supply-demand imbalance. And that's quickly resolved itself, right? And things are starting to return back to normal, and economic growth is kind of muddling along because in that environment, you're spending money on non-productive assets. In other words, I give somebody money, they spend it, it's done. The difference with this AI structure, and the more I'm digging into this, is that this is a very different way of spending both actual money, so free cash flow, which is one of the concerns, but yes, the debt that's being taken on is different from the standpoint that this is productive debt. In other words, that debt will create revenue. And so when you start thinking about building out a data center, the infrastructure, all the components that go into this, the electricians you have to hire, the roads you have to build, the power generations that you've got to build and deliver, that has a bigger multiplier effect in the economy. So, there's some estimates right now that they're going to spend $5 trillion roughly on these data centers, and that's going to generate somewhere in a 3 to 4 range in terms of a multiplier. So you're talking about $15 to $20 trillion spread over the course of 5 to 8 years in the economy, which is going to create stronger economic growth. And so the question to you is that if that occurs and we do see stronger economic growth, would that not attract more foreign reserves into the U.S. economy and thereby strengthening the dollar?
Well, and I think it would, and that was what you just described was kind of my thesis back in 2019 when I first started talking about this, and that was probably the most controversial part of it. As I said, due to a number of reasons, I think capital will come into the United States, and as the economy expands, it'll be kind of a multiplier effect, right? But you can't go buy U.S. assets without first buying U.S. dollars, right? And so I am of the belief that we are overdue for a correction. I think valuations have gotten extended, and I've been doing this for 25 years now. I don't think markets move in a straight line forever.
You and I agree on that 100%.
So I think we're overdue for a correction, but I am not in the apocalyptic depression on the horizon camp. I think after we get this correction, there will be a government response. I think a lot of this money will get spent, and and I think capital will still continue to favor the United States over the rest of the world. And there's another go ahead.
No, please go ahead.
There's another component to this that I think has to be considered, especially when it comes to AI. So I'm a big believer in AI. I think it is transformational. I think the valuations have got a bit silly and the expectations have got a bit silly in the short term, but I do think it's transformational. But there's a bigger issue here, and that is that not only is this an issue for capital markets, but part of the reason why I think it will continue to grow is the existential issue for the United States as the global hegemon. And what I mean by that is this, however you want to classify the current situation with China or Russia, or the East versus the West, whether you want to classify it as an amicable divorce or a full-scale war, anywhere in between those two, this is happening. This separation is happening. And it doesn't matter which party's in the White House. This is the way that the pendulum is swinging. And the U.S. government and all the different branches of the government and the branches of the military, they all agree that this is an existential issue, that the United States must become self-sufficient, or at least regionally self-sufficient, and no longer depend on China for needed inputs.
Right.
And they are going to use every resource at their disposal to do this. And there's a newly launched program through the Pentagon that I don't think too many people know about, called the Office of Strategic Capital. And they got a big funding from the Big Beautiful Bill. And they are going to go out and they are going to invest in these critical technologies and critical mineral sectors to make this happen. Now, will it be perfectly successful? Will it work exactly as intended? Probably not. Government programs never do. But the idea that none of it's going to work and it's all going to fail, I think, is equally naive. And so I think that is going to be a tailwind for markets in the U.S. and in allied countries.
I think this is a hugely important point from the standpoint that, you think about the Cold War that we had between, us and Russia during the whole nuclear, weapons build out thing. To me, this is very similar in terms of this is a race to win AI. And whoever dominates this race is going to have a substantial leadership in the global economy, right? If China wins the AI race, it's going to give them a substantial foothold in the global economy because of the dependency on AI in the future. And it's interesting. I had a chart the other day. I was trying to find this real quick, but is showing the amount of money being spent on data center build-outs and these type of things. And what's important is that when we throw around this term data center, right? And it's just, it's this building that holds data, right? That's a data center. That's really incorrect. These are data factories. And factories, the difference is that factories produce revenue, not a center. A data center it just stores things, but a factory produces revenue. And if you look at the spending that's being put into these data factories, the U.S. is not only, ahead of China. Europe is barely spending any money on AI. And, next year, the OECD predicts that Europe is going to grow at about 1%. The U.S. will grow at 2%. China is going to grow somewhere, on kind of a relative basis to the U.S., so around 2% growth. So, it's interesting is that Europe's not even trying to play this race right now, which means they're going to lose this race. The race is between us and China, or should I say China. So, but, and I think, and this is, to your point, is that the U.S. understands that we have to win this race, that we have to develop AI. We've got to put this money into it. And I've said for a long time that ultimately there's two big hangups with AI, which is, one, the power generation, right? Getting the power to the data centers. The electric grid is too outdated to handle that. There's going to have to be governmental investment into that. And I'm okay using debt for that because this is productive investment. This is the Hoover Dam back after the Depression. This is the Tennessee River Valley Authority. That type of debt pays for itself over time and creates economic growth. So I'm completely okay spending money on debt building out the power grid for this because it's something that we have to do. But this is also going to pull in a lot of private money as well. Again, going back to the multiplier effect in the economy. But I agree with you is that, the U.S. realizes that how important and critical this is for the future and that we have to win this race.
No, that's absolutely right. And, you made a comment there that I'll just tag on to is that, this Office of Strategic Capital that is within the Pentagon, they received a lot of funding as a result of the Big Beautiful Bill. The guy that's running the Office of Strategic Capital, his last name's Feinberg. He used to run a company called Cerberus, which is one of the largest and most successful private equity firms in the world. And so this is not a guy that likes losing money. This is not a guy that hands out money easily. So this is not a typical government program where some, government bureaucrat or career, Army general has a bunch of funds allocated to him and he just spends it on whatever he wants. I mean, this is kind of bringing in, very high level Wall Street expertise to fund these industries that are critical to the United States. And they are then going to partner with private capital to make this happen. So it's not all just coming from the government. They're going to partner the Office of Strategic Capital money along with private market money to fund these industries. And like I said, I don't know that it's going to work perfectly, but I know it's going to happen. And that's a tailwind. And whenever you're investing, you're always looking for a tailwind, right? Whether it's falling interest rates, whether it's QE, whether it's new entrants coming into a market, you want the wind at your back. This is going to be, not only is it an existential issue, but you got the full force of the government with the wind at your back. To me, that's an area that makes me very interested in. So we're going to be investing in this area.
One thing that kind of plays into something you said earlier, back when the Fed was doing QE, this was part of the origination of the dollar milkshake theory. We just saw the Federal Reserve announce the end to QT, which they've already been, they were originally at 25 billion. They reduced it to 5 billion. Now they're going to end it. And it was interesting to how quick they decided to end it. It wasn't like we'll end QT at the beginning of 2026. It's like, no, we're going to end QT at the end of the month. Mike and I just recently had this conversation discussing the fact, in fact, Mike wrote an article talking about the return of QE here at some point. If the Fed comes back with more QE at some point or some form of it, it may not necessarily be outright QE, but again, could be some other form or fashion of QE to provide liquidity to the banks. We obviously have the issues with the reserve repo going on right now. Is that going to fuel, kind of fit right back into your original theory of the dollar milkshake?
Yeah, I think so. And it's funny because bringing this up made me think of something that I think there's a lot of people out there who have said the only reason the dollar is still at 100 was because they raised rates in 2022, but now they're going to go back to QE and that's going to make the dollar fall again. And, it's going to be the end of the dollar. Well, QE in the United States, at least, really started in 2008 and 2009. Mm-hmm. So just go back and look at where the dollar index was in 2008 or 9 and look and see where it is now. Right. And tell me whether or not QE is what makes the dollar fall. And here's the reason why. When the Fed is doing QE, they are trying to plug a hole in. They're trying to put new money in to plug a hole where money is draining out. So the way to think about it is that you can't confuse new money coming in with more money overall. Because think of it like a swimming pool that's full of water and you've got a hole in the bottom and the water is draining out of the bottom. The Fed has to pour more water into the top than is draining out of the bottom to keep it level. Now, while they're doing that, they're also trying to plug that hole at the bottom. But that doesn't always just happen just like that. Sometimes it takes a few weeks. Sometimes it takes a few months. Sometimes it takes 6 months. But the point is, I do think that they will probably, the QT was probably the first step. They're probably trying to plug that hole, right? But if they're not able to plug that hole, then they're probably going to have to start pouring money in from the top, right? Water into the swimming pool from the top. But again, there's no guarantee that they're going to fix that hole at the bottom before they start pouring money in from the top. So just because they start pouring in money from the top doesn't mean the swimming pool is going to overflow. It probably eventually will, and you have to be prepared for it. But it's not a guarantee. And that's my point with all of this stuff. I think there's a lot of people out there who think the markets cannot go down because governments are there to save us. But then on the other hand, they'll tell me the government can't solve everything. So I agree, the government is going to try, and they're very good at kicking the can down the road. But all of these assumptions that I feel like there's a lot of assumptions that are made that are like 100% probabilities when nothing is ever 100%, and you need to be prepared for all scenarios. And that's part of the reason why I push back so hard against the dollar de-dollarization and losing the global reserve currency. And like the bets that you're making that that's going to happen, it's not that they're not possible. It's just that it's very improbable. So don't put all of your portfolio on a bet that's not 100% probable.
I couldn't agree with you more. So Brent, look, this is all a great point, and we're getting a little bit long in our interview today. It's been a great conversation, but I really want to touch on stable coins because this is something that is starting to get a lot more traction. You recently did a report talking about stable coins. We've been writing about stable coins here for a little while, and stablecoins have a potential to impact both the U.S. dollar as well as the U.S. bond market. So, kind of explain your and just assume that our audience doesn't know anything about stablecoins. What are they? And kind of explain what your thesis is.
Yeah. So the best way to think about a stablecoin it's a digital token. It to a certain extent, it's like Bitcoin or Ethereum. It's digital form. There's no physical form. It can be transacted very quickly. It's typically tied to a blockchain, and it can be exchanged with somebody anywhere in the world within a couple of seconds. Now, some stable coins are intended to change in value based on certain underlying factors. A stable coin is linked to a specific asset or commodity. So you could have a gold stable coin, you could theoretically have a copper stable coin, you could have currency stable coins. In this case, we're talking about a dollar stable coin. And so what that means is it's not supposed to necessarily hold its value from a purchasing standpoint. It's supposed to be stable versus the US dollar itself. So if you buy a US dollar stable coin today, it has the equivalence of a US dollar. 3 weeks from now, it's not going to trade at 60 cents on the dollar. At least it's not supposed to, right?
Right.
The way they maintain.
And just real quick, this was really important because we saw some companies come out, previously with Bitcoin. Tesla said, "Hey, yeah, we'll accept Bitcoin for you can purchase a Tesla with Bitcoin. It's great." Ran that for a little while. They quit because you can't transact business, particularly if you're having to deliver an asset overseas. Where you've got, delivery times, those type of things, and you've got your currency swinging 30 or 40% in a week, right? And so the importance of the stable coin is it strips that volatility out so that businesses can now conduct transactions with reliability in the economy.
Yeah, and that same point, I meant to mention this earlier when you were asking me about reserves. That's also part of the reason countries hold dollars as reserves, because it matches their reserves with their liabilities. Mm-hmm. You don't want to be speculating in the currency markets when you have bills coming due that you need to pay. So the reason the US dollar stablecoin, I think, is pretty interesting. A couple years, and the first thing I'll say, these have been around for probably 10 years or something like that. Mm-hmm. And I was initially pretty skeptical about them, mainly because of the backing part of it. It wasn't really clear how they were maintaining the stability and what they kept in reserves to back it. And there was some very, shady practices going on with some of the companies. But the reason I've gotten interested more in them recently is because of the passage of the Genius Act, which is where the United States, kind of on an official basis, to a certain extent, blessed stablecoins. Mm-hmm. And when you start kind of reading between the lines of why they would do that and the power it would give them, it starts to get extremely interesting, not just from an economic standpoint, but from a geopolitical standpoint, from a power standpoint, from a domestic security standpoint. It really becomes a tool of empire, for lack of a better word. And I would argue that the government is using the tools that the private market developed as a way to escape the dollar system in order to enhance the dollar system. And what I mean by that is, as stable coins become more accepted, or they proliferate, they're going to become more accepted as a preferred medium of exchange because they're quicker, they're more efficient, they're cheaper. And if the US on an official level starts using them as well, or starts asking for payment over a new stablecoin system or the new rails that are developed as a result of stablecoins, it has the potential to become a new Eurodollar market or take place of the old Eurodollar market. We haven't really talked about the Eurodollar market today, but the Eurodollar market is the market of dollars that developed outside the United States after World War II, much for the reasons we talked about earlier, whether it's buying, trying to match your reserves to your liabilities, whether it's transacting for needed commodities. So the market for dollars outside the United States is already much bigger than the market for dollars inside the United States. The problem is that the United States controls that system to a certain degree, but they don't have full visibility. They don't have full control. Earlier, I talked about the importance of sovereignty for a nation. Any government is going to want to have as much control as they can. Now, we as individuals don't like that. It's always this back and forth. But from a government perspective, they want to have control. And this potential stablecoin system gives them a lot more visibility and a lot more control than they currently have. And all they would have to do is say, you know what? Anybody that the government is doing business with, all of our vendors, rather than using the traditional SWIFT system or Fed wires, we now want to get paid via the stablecoin on this specific blockchain. And that will immediately create demand for that new system. Not because people necessarily want it, but because they would have to have it. Now, where this then becomes a big deal globally is many countries around the world have currencies. As bad as you think the dollar is, their currencies, their local currencies, are even worse. And the citizens and the business owners and the people that live in those jurisdictions already try to hold dollars to the extent that they can. Now, all you have to do is go next time you travel outside the United States, just ask them, and they will tell you this is the case. This isn't me just making this up. This is a fairly easily verifiable phenomenon.
Right.
And but to do that in another country, you have to go to kind of a local currency exchange. You have to do it in dollars. Then you have to store, or you have to do it in physical currency. You then have to store that physical currency under your bed, which carries risks. You can occasionally find a bank that will allow you to hold, a dollar balance, but then that can very quickly be turned off by the local authorities. And so really what this provides is a way for anybody that has a smartphone and access to the internet to all of a sudden hold a US dollar balance that is not perfectly out of control of their local government, but harder for their local government to control than the current methods. And so it's a way for, as the private market starts to adopt these stable coins as their preferred means of holding short-term, balances for either their businesses or to protect against their savings versus their local currency, it's a way for the US dollar to kind of infiltrate these countries on a greater basis than it already has. And that process starts to steal sovereignty from those local governments. It's kind of an ingenious system when you sit back and look at it. And I know some people will say the US government is not smart enough to pull this off. Well, perhaps they're not. But what I find interesting about it is that if you look through the US Army handbook and you look through military doctrine, there is actual documents and programs already in place that describe money as a weapon. They know how to use money as a weapon. The US Treasury has an entire department that is focused on using the money as a weapon. So the idea that
the Federal Reserve's been doing that for years as well, through dollar swaps.
Exactly. So I think people need to, and some people like this and some people hate this. But the fact of the matter is, government sits on one side of the table and the citizens sit on the other. Now, the government's supposed to represent the citizens, but do they really? You kind of got to ask yourself sometimes, right? But the point is the government will use money as a form of control to get you to act a certain way, whether it's tax breaks, whether it's certain incentives, whether it's different special loan programs through a government agency. They will use money or economics as a way to influence activity. So the idea that they would use it against you as a local citizen, but they wouldn't use it against a foreigner, I think is being very naive. Of course they would. And so, or at least they would like to have the ability to do so. And so when you start looking at these stable coins as a tool of government and rather than just a tool of the private market, you can see how it could proliferate pretty quickly, how the United States would prefer or wouldn't mind this to spread globally, because once it spreads globally, because the demand is already there. The demand has already been proven to be there. It's just a matter of which channel. If they could have that demand switch from a channel they can't control to a channel they can, it becomes pretty compelling.
So let's let's move that conversation into, as investors, what does this mean for certain assets? So, for instance, if they're going to issue, if the stable coin does build a foothold, which I think there's a reasonable probability that will eventually be the case at some point, particularly if we do start to move into where there's more transactions occurring on the blockchain, et cetera, and that's kind of where the future looks like it's headed. What does that mean for the U.S. dollar? What does that mean for U.S. Treasury bonds, which would be the backing most likely behind the stable coins themselves?
Yeah, I mean, I think I don't necessarily think it increases demand for treasuries, because I think there's already a lot of demand for treasuries, but it certainly helps and it certainly does not hurt.
Oh, no. Hang, Brent. Everything I've been told is that nobody wants our treasuries anymore.
Well,
even though foreign demand for treasuries at all-time records. But other than that, I mean, yes, nobody wants our treasuries anymore.
That, right?
Yes.
Right. And so, it's going to increase the flow of dollars around. I think it's going to increase the dollarization of the world rather than de-dollarization of the world. It's going to provide a new channel via which the U.S. government to fund itself. It especially helps them fund on the short end of the curve, which they are currently doing, because stablecoins, in order to remain a stable value, they can't go load up with 30-year bonds, which can fluctuate wildly. Right. So they're going to be buying more T-bills and short-term bonds than longer-term bonds. And then some of those assets, though, I think end up flowing into U.S. assets, right? Once you own U.S. dollars, it's not that much bigger of a step to go buy U.S. real estate or U.S. stocks or U.S. denominated assets. So I think it kind of contributes to the quote unquote milkshake theory, where, the U.S. and U.S. assets continue to outperform the rest of the world. Now, I should say, this doesn't guarantee that they perform well. I just think that they perform better than the rest of the world. And as the dollar, as these other countries start to get quote unquote dollarized, that causes problems for them locally. It causes problems for their domestic market. It causes problems for their domestic governments. And that's honestly, I think the rest of the world is scared of these dollar stablecoins, and I think they should be. Yeah. Because I think it's a very big deal.
And I think you brought up a really important point earlier, which is, when President Trump ran for his first term, he talked about how China was manipulating their currency, relative to the U.S. We've been manipulating our currency to some degree or other really since the early 1920s. And, and again, this goes back to the dollar as a functioning part of the economy. If it's too strong, it hurts the U.S. economy. If it's too weak, it's not good for the U.S. economy. So, there's a reason to try to keep that dollar relatively stable relative to other currencies. It's the same reason that China adjusts, their yuan to try to peg it as close as they can to the U.S. dollar, because it's the same thing. It impacts them. And so, for a lot of these people saying, well, the dollar, we've lost reserve currency status, nobody wants our dollars, to think that, in my opinion, and you can agree or disagree, but I think that to believe that, you've got to also assume that the U.S. government is not going to intervene at some point to stabilize the value of that currency to the global economy for the benefit of the U.S. economy.
100%. And I'll talk to people and they'll say, on the one hand, they'll say the United States is the global bully who developed a system to enslave the world via, inflation. That's how they run the world. And then on the other hand, they'll tell me that they're not smart enough to manage their way out of a paper bag. Now, which is it? Are they the global geniuses who developed this, enslavement system, or do they not know anything? And I think there's probably a little bit of truth to both, but I think the idea that you should underestimate the ability of the U.S. government to pull this off, or to maintain their U.S. dollar hegemony, I think that's being naive. And the other thing I'll say is I often will now hear people say, no other country wants the global to be the hegemon. No other country wants the global reserve currency. Let me tell you something. That is complete bullshit. I'm sorry for the language, but this is like saying you don't want the ring of power in the Lord of the Rings, right?
Precious.
Now, if you want to tell me you're Frodo, that's fine. You can believe that. But when you actually hold it in your hand, are you going to give it away? And who are you going to give it away to that you trust won't use it for the reasons you don't want to use it for? That is the global reserve currency. That is global seigniorage. Yeah. Global seigniorage is the ability to print money out of thin air and buy needed inputs with it. And the idea that another country doesn't want that is so ridiculous that it's hard for me to even entertain that argument.
So based on all that, based on this conversation today, and because we get ready to kind of wrap things up here, what are you kind of looking at over the next, say, 12 months, for the markets? Any particular assets that you are worried about, excited about? What should investors be thinking about, as we go forward from here?
Well, I think AI is overpriced currently. I'm not an AI bear. I don't think we're heading into the next Great Depression, but I think everything needs to have a pullback and just let a little bit of air out of the. So in the short term, I'm cautious. But I over the next 12 months, if we got that dip, I would be buying those. I would also be buying energy assets, and perhaps things like uranium or anything related to nuclear, because to power all these things, we're going to have to become more energy self-sufficient as well, and generate more power. I do think the risk of the dollar is to the upside, not to the downside. If the dollar falls, that's actually I don't mind, because if the dollar falls, then it's probably a tailwind for risk assets. And then the other thing is I'm bullish these covered technologies and critical minerals areas, because as we discussed before, this Office of Strategic Capital has designated these specific industries as national security interests, and you get that tailwind there. You always want a tailwind rather than running into a headwind.
Right.
So those are the areas I'm most excited about.
So the dollar has a kind of a historically long negative correlation with precious metals, what you've been a big proponent of precious metals for a long time. It's performed very well. Kind of what's your forward view for, there's a lot of people that piled into precious metals just very recently when we had this big spike. The spike always kind of drags in the last of the holdouts. Kind of what's your outlook for precious metals over the next year?
I mean, I think if you own them, I don't think you need to sell them, right? Hopefully you've already owned them. We're not selling ours, but we're not buying more at these prices either. I would expect them to probably trade sideways to down a little bit over the coming months. But I think of gold much differently than most gold investors. Most people I talk to in the gold world think it's going to make them very rich or very wealthy. I think of it more as a way to protect against some kind of a global calamity and the debasement of currency over time.
Right.
And so it's funny because I look at the price of gold the very first thing when I wake up in the morning, just because I think it's a great weather vane, but I don't really think about it that much because I'm going to own it regardless of what the price is, because to me, it's a strategic allocation as opposed to I would rather speculate on something else rather than speculate on gold. But I think everybody should have gold in their portfolio.
That's a great point. And to your point about energy, it was interesting because Mike and I absolutely agree with you. In fact, we just launched today a energy specific portfolio on SimpleVisor because of that same thesis. Now, we don't think it's going to work in the near term. It's going to be something that you should dollar cost average into. I mean, it's not something you buy today and expect to make money on tomorrow. But absolutely, we both agree with you that this energy power demand is significant to what's going to happen with the energy markets. And that doesn't mean every stock's going to participate equally, but we think there's a real opportunity in the energy sector that could surprise a lot of people.
Yeah, if you look, I met this really great energy investor. His name's VanLowe. He runs Quantum out of Houston, probably one of the best energy investors in the world. I met him a few weeks ago, and he kind of walked me through his thesis. Incredible guy. And he was basically walking through what is the demand for energy over the next 5 to 15 years, and what is the current supply of energy over the next 5 to 15 years. And there is an incredible supply imbalance to what is needed. And his point was, I don't know that it's going to happen today. Maybe oil goes to $50 in the short term, but it's going to $100 in the next 10 years, right? And perhaps significantly higher.
Yep.
And I tend to agree with his analysis there.
No, I absolutely. I mean, there's just no way with the amount of. So, just as an interesting side story, my wife works for a company that creates LNG. And there's a gap in the window right now. If I'm building a data center today and I want to get on natural gas, because I can't get to nuclear. Nuclear's 10 years out, right? So if I want to get to natural gas, it's 2 to 3 years to build what we call behind the meter power generation for these data centers. But LNG can provide a very short-term solution, because you can put a tank on the data center site, provide immediate power to these data centers while they're getting built. And so they're already figuring out ways to get power, but all of that relates back to, in some shape, form, or fashion, energy. And it doesn't matter how if you're going to develop on nuclear, develop on natural gas, wind and solar, they could provide a very small percentage, but they're inefficient technologies. So they're never going to be the main power provider for the amount of power required. And again, when you start looking at the amount of data centers that we're talking about building over the next few years, you're talking about a minimum of 30, probably 20 to 30 to 40 nuclear reactors just to power those. Forget everybody else, right? Forget having power to your house, right? That's just for those guys. So, and this is kind of our thesis as well, is that there's going to be such demand. I don't know if prices are going to 100. I do agree that prices are probably going to go to 40 or 50 maybe over the next year or two. We'll see what happens. And that'll be related more to an economic slowdown than anything else. But eventually, that demand hook is going to catch, and you're going to see significantly higher oil prices, and those stocks should do very well. And that's our bet anyway. That's why we built the portfolio.
Same.
Yep. So, Brent, thank you so much for your time today. It's been awesome as always. Where is the best place for our listeners to find more about your work?
Yeah, so I'm pretty active on social media. If you go to Twitter, if you look up Santiago Capital, my symbol's a white seashell. And the best way to follow our work is go to research.santiagocapital.com. We've got a couple different levels there. We write generally about the intersection between capital markets and geopolitics, with an overlay of the madness of crowds. So, we talk about what's going on in the world. What we generally write about is the stuff that we find interesting and that we think is important. We're not necessarily telling you to buy this stock at this price and sell it at that price. Right. We're trying to make you think about what's going on in the world and how to think of it from a big picture perspective.
Well, Brent, that's great. Thank you so much for your time today. We appreciate it. Love to have you back here, sometime soon as things continue to develop. And if you're watching this channel right now with Brent, be sure and like and subscribe to our YouTube channel, because your support helps us get guys like Brent on the show to interview, to give you the information that you're looking for. So hit the like and subscribe button to our YouTube channel, as well as get by our website, realinvestmentadvice.com. Let us know who you want us to interview. Let us give us ideas of who you would like to hear from next. And of course, if you have any questions or comments, be sure and drop those in the comment box on the website, realinvestmentadvice.com. That concludes today's interview edition of The Real Investment Show, and we'll see you back here next time for The Real Investment Show. Have a great day.